I want to start this video with a question, and I want you to sit with it for a moment before I answer it. Bitcoin rallied hard recently. The recovery has been strong. People are starting to feel optimistic again. Social media is filling up with bullish calls, new price. Targets are getting thrown around, and the general mood is shifting from fear back toward excitement. So here's the question. Does a strong rally mean the bottom is in? Most retail traders would say yes. Price went up. The worst is over. Time to buy. But what if that's exactly what the market wants you to think? What if that strong rally, the one that's making everyone feel good right now, is precisely the setup that leads to one more leg down before the real recovery begins? Today, I'm going to walk you through one of the most important macro analyses you need to understand about Bitcoin's current position. Not the day-to-day price, action, not the 4-hour chart. The big picture, the cycle, the historical patterns that have played out in Bitcoin's history over and over again, and what they are, telling us right now about where this market is actually headed over the next 6 to 12 months. This is going to be a long video, a detailed video, because the situation deserves that level of attention. If you've been wondering whether to buy here, whether to sell, whether to hedge, whether to hold, this video will give you the framework to make that decision intelligently, based on data, based on history, based on market structure, not based on emotion or social media sentiment. Get comfortable. Let's go through every layer of this analysis, from the foundations of how Bitcoin cycles work all the way to the specific setup we're looking at right now and what the historical data tells us is the most likely path forward. Chapter 1. How Bitcoin cycles actually work. Before we can talk about where we are right now, we need to establish the foundation. We need to understand how Bitcoin's market cycles actually work, not the simplified version you see in mainstream media, but the real mechanics underneath. Bitcoin is a cyclical asset. This is one of the most consistent and well-documented characteristics of its entire history. It moves in large multi-year cycles that follow a broadly predictable structure: accumulation, expansion, distribution, and contraction. These cycles are not perfectly identical. The timing varies, the magnitude varies, the specific catalysts are always different. But the underlying structure, the rhythm of how capital moves through the Bitcoin market, has been remarkably consistent since Bitcoin's earliest days. The primary driver of these cycles, at least structurally, is the halving. Every approximately 4 years, the amount of new Bitcoin created per block, the reward that miners receive, is cut in half. This creates a predictable supply shock. Fewer new coins entering the market, combined with demand that tends to grow over time, creates upward price pressure. The halving has preceded every major bull market in Bitcoin's history. But the halving is not the only factor. It's the metronome, the clock that sets the rhythm of the cycle. Within that rhythm, there are other forces at play. Macro, liquidity conditions, how much money is flowing through global financial markets, institutional adoption, whether large players are entering or exiting the space, regulatory environment, how governments are treating crypto at any given moment, sentiment, the psychological state of the market, which oscillates between euphoria and despair with remarkable consistency. Understanding all of these layers simultaneously is what allows you to develop a genuine macro view of where Bitcoin is in its cycle, and therefore what to expect over the coming months and years. Let's start with the cycle phases in detail. The accumulation phase is the first phase of a cycle. This is the period after a major bear market bottom, when price has been declining for an extended period, when sentiment is at its most negative, when most retail participants have either sold or stopped paying attention. During accumulation, large players, institutions, sophisticated investors, long-term Bitcoin holders are quietly building their positions. They are not buying all at once. They are accumulating, slowly, over months, because they are operating with large amounts of capital that cannot be deployed without moving the market if done too aggressively. The accumulation phase is characterized by low volatility, low volume, and sideways price action. Price stays within a range. There are no dramatic breakouts, no exciting news, no viral social media posts about Bitcoin's price. It's boring. And that boredom is precisely what allows large players to accumulate, without driving the price up prematurely. The expansion phase begins when the accumulation is complete and large players have built their desired positions. A catalyst, often a major positive news, event, a liquidity injection into global markets, or the approach of a halving, triggers the initial breakout. Price moves above the accumulation range. Retail. Traders start paying attention. Volume increases. Momentum builds. Once the expansion begins in earnest, it can be extraordinarily powerful. Bitcoin's bull markets have produced returns that are almost unparalleled in any asset class in history. 1,000%, 2,000%, even 10,000% from the cycle bottom to the cycle top. These moves compress years of potential stock market returns into months, and they attract enormous amounts of new capital, from retail investors, from institutions, from media coverage, from ordinary people who have never thought about crypto before. The distribution phase follows the peak of the bull market. This is the most psychologically complex phase for investors because it occurs at maximum optimism. Everything looks great. The price is at or near all-time highs. Every headline is bullish. Every influencer has a higher price target. And underneath all of that, optimism, the same large players who accumulated at the bottom are quietly distributing, selling their positions to the retail investors who are piling in at the top. Distribution is subtle. It doesn't look like selling. The price stays high. Sometimes it keeps making new highs just barely, just enough to maintain the excitement and keep new buyers coming in. But the volume starts shifting. The rate of new highs slows. The momentum starts diverging from price. A phenomenon technical analysts call bearish divergence. And then at some point the selling pressure overcomes the buying pressure and the reversal begins. The contraction phase, the bear market, is the final phase of the cycle. Price declines from the top. At first, slowly. The initial decline is often dismissed as a healthy correction. Analysts say it's a buying opportunity. And for a while, small bounces seem to confirm that the bull market is intact. But then the bounces get weaker. Each rally fails at a lower high than the previous one. The selling resumes. And eventually, the scale of the decline becomes undeniable. Retail investors who bought near the top are now down 30%. 40%, 50%, fear replaces optimism. The news cycle turns negative. Regulatory concerns surface. Industry scandals emerge. They almost always do during bear markets. When the tide goes out and reveals who wasn't wearing a swimsuit, and the bear market continues, historically much longer than most people expect. Which brings us to the most important point for where we are right now. Chapter 2. Bear markets last longer than you think. One of the most consistent findings from studying Bitcoin's historical bear markets is that they last much longer than the average investor expects or is comfortable with. And the reason for this is deeply psychological. When Bitcoin declines from an all-time high, the first instinct of most investors is to frame it as a temporary correction, something that will reverse quickly and allow them to buy back at lower prices before the next bull run begins. This instinct is reinforced by the speed of previous recoveries. If you bought the 2018 bottom and held through 2021, the multi-year bear market still ended with an extraordinary outcome. So the mental model becomes, it will correct, then it will recover, and I just need to identify the bottom and load up. The problem with this mental model is that it consistently causes investors to buy too early during what appears to be the bottom but is actually just a relief. Rally within a larger declining structure. They buy. Price rallies. They feel vindicated. And then price resumes its decline, taking out the lows they bought at and continuing lower. The current bear market started approximately 150 days ago from the all-time high. 150 days. That sounds like a long time. It feels like a long time if you've been experiencing it. But here is the historical context that changes everything. Bitcoin's bear markets have historically lasted between 350 and 400 days from the top to the final bottom, sometimes longer. Let's look at the data. The 2018 bear market. Bitcoin peaked in December 2017 at approximately $19,800. The final bottom came in December 2018, almost exactly 365 days later. One full year of declining prices. And critically, during that year, there were multiple significant relief rallies. Bitcoin bounced from 6,000 to 11,000, from 6,000 again to 8,500, from 5,800 to 8,500 again. Each of these bounces looked like potential bottoms. Each of them attracted buyers who were convinced the worst was over. Each of them rolled over and continued lower. The 2021 to 2022 bear market. Bitcoin peaked in November 2021 at approximately $69,000. The final bottom came in November 2022, again almost exactly 1 year later, 365 days. And again, multiple significant bounces during the decline. Bitcoin rallied from 33,000 to 47,000 in the spring of 2022. Relief rallies of 30%, 40% that felt like new bull markets to those who were watching day to day, but were simply corrective moves within the larger declining structure. The pattern is clear. Bitcoin bear markets historically last approximately 352, 400 days from the top to the final capitulation low. We are 150 days in. That means, if history rhymes, which it has with remarkable consistency, we are less than halfway through this bear market in terms of time. This single data point should fundamentally change how you are thinking about the current rally. Chapter 3. The Myth of the V-Shaped Recovery. Now let's talk about the rally itself, because the recent bounce in Bitcoin has been strong, genuinely strong, and that strength is causing a lot of people to conclude that the bottom is already in. But here is a critical concept that gets overlooked constantly in crypto. The strength of a relief rally is not evidence that a bottom has been established. In fact, some of the strongest rallies in Bitcoin's history have occurred within the context of a continuing bear market. The very strength of the bounce is part of what makes it a trap. It generates enough optimism and FOMO to bring buyers back in, which provides liquidity for the next wave of selling. Let's talk about V-shaped recoveries, the pattern where price drops sharply and then immediately reverses and goes straight back up, as if the decline never happened. These are extremely rare in major bear markets, not just in Bitcoin, in any asset class. After significant structural breakdowns following all-time highs, the market almost never recovers in a straight line. Why? Because of the overhang of trapped buyers. Think about everyone who bought Bitcoin during the previous bull market at $80,000, $90,000, $100,000, $110,000. Those buyers are now sitting on significant losses. They have been holding through months of decline, hoping for a recovery. When price bounces strongly, when it rallies 30%, 40%, 50% from the lows, those trapped buyers see an opportunity to either break even or reduce their losses. They sell, and that selling creates resistance at every level where significant buying occurred during the previous bull market. The technical term for this phenomenon is overhead supply. There is an enormous amount of Bitcoin that was bought at higher prices, held through the decline, and is now waiting to be sold the moment price gets close enough to break even. This overhead supply acts like a ceiling. Price approaches it. Selling pressure increases, the rally stalls, and the decline resumes. The higher Bitcoin rallied in its previous bull market, and it went very high, the more overhead supply exists at those levels, which means that a genuine, sustainable recovery requires working through all of that overhead supply before a new bull market can begin. And that process takes time. Historically, 2 to 3 months of consolidation at a minimum, sometimes much longer. This is not bearish. This is not a prediction that Bitcoin goes to zero. This is simply the mechanical reality of how markets process large directional moves. They don't reverse on a dime. They consolidate. They retest levels. They allow the trapped buyers to exit and the new buyers to accumulate. And then, when that process is complete, the next directional move begins. The current setup shows price has bounced strongly from the lows. It has rallied into a major historical support-turned-resistance level. And it is now at precisely the type of level where, historically, the bounce runs out of momentum, and the market spends weeks or months consolidating or retracing before making its next significant move. The question is not whether this level will hold or reject. The question is whether you have positioned yourself correctly for either outcome. Chapter 4. The Retest Setup. Why it matters now. Let's get specific about the current technical setup because this is where the macro analysis connects to actionable price levels. Bitcoin has rallied from its recent lows into a major historical high time frame, support-turned-resistance level. This is a zone that has been significant in previous cycles, a level that acted as major support during the previous bull market and has now flipped to resistance as Bitcoin trades below it. When a major support level breaks and price falls below it, that level does not simply disappear from the market's memory. It transforms. It becomes resistance. And when price eventually rallies back to test that level from below, which it almost always does, the reaction at that level tells you everything about the underlying strength of the market. A strong rejection from this level, a failed retest, confirms that the bears are still in control. It confirms that the overhead supply at that level is too great for buyers to overcome. And historically, it leads to a continuation of the downtrend, a move to new lows that establishes the actual bottom from which the next bull market can begin. A successful reclaim of this level, where price pushes through, consolidates above it, and the level flips back to support, would be a significant structural change. It would suggest that the bear market is potentially over and that the recovery is genuine. But this scenario requires a weekly close above the resistance zone with sustained buying pressure, not a single candle spike. Right now, we are in the middle of the retest. Price is pressing against the level, and the most probable outcome, based on historical pattern, based on where we are in the cycle at 150 days, based on the amount of overhead supply that exists above current price levels, is a rejection. Not an immediate catastrophic drop, a rejection. A failure to sustain above the resistance zone, and then a period of consolidation or a controlled decline back toward lower levels where the real accumulation can begin. This is not a prediction. I want to be clear about that. This is a probabilistic assessment based on historical data and current market structure. The market does not owe us anything. It does not follow scripts. And if the structural evidence changes, if we see a strong weekly close above resistance with expanding volume and improving market breadth, then the thesis changes with it. But until that evidence appears, the most disciplined approach is to respect what history is telling us and plan accordingly. Chapter 5. What large players actually do at bottoms. Here's something I want to spend real time on because it fundamentally changes how you should be thinking about the timeline of this recovery. Most retail investors think of market bottoms as single moments, a specific date, a specific price, the day the market hit the lowest point and then reversed. They imagine large players, the institutions, the hedge funds, the sophisticated capital, sitting there with their fingers on the buy button, waiting for the exact bottom, and then executing massive purchases the moment it arrives. That is not how it works. Large players cannot deploy capital the way individual investors can. If you have $1,000 to invest in Bitcoin, you can buy it right now on any exchange in seconds. Your purchase has essentially zero impact on the price. But if you have $500 million to invest in Bitcoin, which is what a meaningful institutional allocation looks like, you cannot just hit buy and be done with it. Your purchase would move the market significantly. You would be buying into your own order, driving the price up against yourself and reducing your average entry quality. So large players don't buy at the bottom. They accumulate at the bottom over weeks and months through a process of carefully sized purchases spread across a range of prices, timed to minimize market impact and maximize the quality of their average entry. This accumulation process requires time, 2 to 3 months at minimum for meaningful institutional capital, sometimes longer. And during that time, price tends to stay in a range, not making dramatic new lows, but also not breaking out aggressively to the upside, because the large players need the price to stay low, long enough for them to finish building their positions. If price rallied immediately and aggressively after the initial bottom, large players who had only partially filled their positions would be left with incomplete allocations, or forced to buy at significantly higher prices, reducing their return potential. So during the accumulation phase, there is a structural incentive for price to remain suppressed, to consolidate, while the big money finishes its work. This dynamic explains why genuine bottoms are almost always followed by periods of boring, sideways price action rather than immediate V-shaped recoveries. The consolidation is not weakness. It is the mechanical process of large capital being deployed. It is the foundation being built for the next bull market. Understanding this changes your entire framework for when to expect the next bull market to begin. It's not when price hits the lowest point. It's when the accumulation is complete, when large players have filled their positions, and the structural dynamic shifts from suppression to expansion. How do you know when that transition is happening? Look for sustained higher lows on the weekly chart. Look for volume patterns that show accumulation. Higher volume on up days than down days over a sustained period. Look for the gradual compression of volatility as the range tightens and the price structure stabilizes. Look for improvements in market breadth. Altcoins starting to perform relatively well, indicating that capital is flowing back into risk assets across the board. These are the signals that precede genuine bull market beginnings. They do not appear overnight. They develop over weeks and months, and they are almost always visible in hindsight, and almost always invisible to the majority of market participants in real time, because the majority are too focused on day-to-day price movement to see the larger structural pattern developing. Chapter 6. Historical Cycle Comparisons in Detail. Let me now walk through the historical cycle comparisons in detail, because this is where the current setup really comes into focus. Going back to 2017 and 2018, Bitcoin peaked at approximately $1,900 in December 2017. At the time, the mainstream narrative was that this was just the beginning. Institutional money was coming. The technology was going to change the world. Price predictions of $50,000, $100,000, even $1 million were being published by mainstream financial media. Then the decline began. In the first month, Bitcoin dropped approximately 45%. Brutal. But almost every analyst called it a healthy correction within a larger bull market. The target was still 50,000. You just had a cheaper entry now. The bounce came. Bitcoin rallied from approximately 6,000 back to 11,800, a 97% rally from the lows, almost double. Anyone who sold at 6,000 thinking the bottom was 11,800 was now kicking themselves. The bull market was back, right? Wrong. The bounce failed at the previous resistance zone, the area around 11,500 to 12,000 that had acted as support during the bull market. A textbook bearish retest of a broken support level. And from that rejection, price fell back to 6,000, then below it, eventually reaching the final bottom at approximately $3,100 in December 2018, 1 year after the all-time high. The people who bought the 97% bounce at 11,800, thinking the bottom was in lost. Another 75% from that entry before the real bottom arrived. Now let's look at 2021 to 2022. Bitcoin peaked at 69,000 in November 2021. Similar narrative. Institutional adoption was accelerating. ETFs were launching. This was going to be different from previous cycles. The decline began. Bitcoin dropped to 33,000 by January 2022, a 52% decline from the top in just 2 months. Strong bounce followed. Bitcoin rallied from 33,000 all the way back to 47,500, a 44% rally. Again, the narrative emerged that the bottom was in. The dip was bought. The bull market was resuming. Wrong again. That 47,500 level was a major resistance zone, a level that had acted as significant support during the bull market and was now being retested from below. The rejection was sharp and decisive. From 47,500, Bitcoin fell through 30,000, through 20,000, and eventually reached the final bottom at approximately 15,500 in November 2022. The people who bought the rally to 47,500 lost 67% from that entry before the real bottom. Do you see the pattern? In both previous major bear markets, there were significant relief rallies, rallies of 44% to 97, sent from the lows. That occurred well before the final bottom was established. Both of these rallies retested major previous support levels that had become resistance. Both of them attracted buyers, who were convinced the worst was over. Both of them failed sharply and led to new lows that completely wiped out the relief rally buyers. We are now 150 days into the current bear market. Bitcoin has had a significant rally from the lows. That rally has taken price into a major historical resistance level. We are at 150 days in a bear market that historically lasts 350 to 400 days. The pattern is not identical. It never is, but it is rhyming loudly. Chapter 7. The Argument for the Bulls. Why this cycle could be different. I want to spend real time here because intellectual honesty requires me to present the strongest possible case for the opposing view. I am not inherently bearish on Bitcoin. I am a believer in Bitcoin's long-term trajectory, and there are genuine reasons why this cycle might play out differently from previous ones. The first and most significant difference is institutional infrastructure. In 2018, there were no spot Bitcoin ETFs. There was no regulated futures market with meaningful institutional participation. There was no way for a pension fund or sovereign wealth fund to get meaningful Bitcoin exposure through their standard investment channels. The market was almost entirely retail-driven. That has changed dramatically. Since the launch of spot Bitcoin ETFs in January 2024, billions of dollars of institutional capital have entered the market through regulated vehicles. BlackRock's IBIT has become one of the most successful ETF launches in history. Fidelity, Invesco, and multiple other major asset managers have substantial Bitcoin ETF products with significant assets under management. This institutional presence changes the market structure in meaningful ways. Institutional investors tend to have longer time horizons and more stable hands than retail investors. When Bitcoin drops 40%, a retail investor panics and sells. A pension fund with a 1% Bitcoin allocation rebalances, actually buying more to maintain their target allocation. This creates structural buying pressure during declines that simply did not exist in previous cycles. The data supports this. Even as Bitcoin has declined significantly from its all-time high, Bitcoin ETF inflows have remained remarkably resilient. There has not been the kind of mass outflow that would be expected if institutional investors were abandoning the asset class. That is a meaningful structural difference from 2018 and 2022. The second argument for the bulls is the maturation of the market overall. With each cycle, Bitcoin's market cap grows. Its liquidity deepens, its user base expands, and as the market matures, it tends to become less volatile. The extreme percentage swings characteristic of early Bitcoin cycles moderate over time because more capital and more diverse participants create a more balanced market. A bear market that produced 85% drawdowns in 2018 and 77% drawdowns in 2022 might produce only 55% or 60% drawdowns in 2025 and 2026. The structure of the cycle might be the same: accumulation, expansion, distribution, contraction, but the magnitude of each phase could be dampening over time. The third argument is macroeconomic. We are in a different global monetary environment than in previous Bitcoin bear markets. Central banks have gone through a rate hiking cycle and are now navigating the complex transition back toward easing. Global liquidity conditions are changing, and Bitcoin has historically performed extremely well in environments of expanding global liquidity, which is the direction the macro environment is heading. The fourth argument is adoption. Each cycle, the number of people and institutions using Bitcoin grows. The Lightning Network is expanding. Nation-state adoption is increasing. The infrastructure around Bitcoin, wallets, exchanges, custodians, financial products, is more robust and accessible than ever. And adoption tends to create a rising floor for each cycle. The lows of each bear market are higher, in absolute terms, than the lows of the previous bear market, because the base of genuine long-term holders is larger and more committed. These are real arguments. They are not to be dismissed, and they are part of why I said at the beginning I am not inherently bearish The long-term trajectory of Bitcoin remains strongly positive in my view. But, and this is the critical distinction, the long-term trajectory being positive does not mean the short to medium-term path is straight up. It does not mean the bear market is over at 150 days. It does not mean this rally is the beginning of the next bull market rather than a relief bounce within a continuing bear market. The structural arguments for why this cycle could be different are arguments for why the ultimate bottom might be higher than in previous cycles. They are not arguments against the cycle having a bottom that hasn't been reached yet. Chapter 8. How to Position Yourself. The Hedging Framework. Let's talk about the practical implication of everything. We've discussed how to actually position yourself given this macro outlook. First, let me be clear about what I am not saying. I am not saying sell everything. I am not saying Bitcoin is going to zero. I am not saying the bear market is going to last forever. Anyone who gives you that kind of absolute, confident prediction about this market is selling something. What I am saying is that the current setup, 150 days into a bear market, price at major resistance, historical pattern of 350 to 400-day bear markets, relief rally, into overhead supply, presents a risk profile that needs to be managed. Not panicked about, managed. There are several approaches, depending on your situation, your time horizon, and your risk tolerance. The first approach is for long-term Bitcoin holders who believe strongly in the asset and are not concerned about short to medium-term price fluctuations. If you have a true multi-year time horizon, if you are prepared to hold your Bitcoin, regardless of what happens over the next 6 to 12 months, and if your position size is appropriate relative to your total net worth, the simplest approach is to hold, dollar cost average on further weakness, and stop checking the price every day. The bear market will end. The next bull market will begin. If your thesis is Bitcoin over a 5 to 10-year horizon, none of what is happening right now changes. The fundamental investment case. The second approach is for active investors who want to preserve capital in the short term while maintaining long-term exposure. This is where hedging becomes relevant. A hedge is not a bet against Bitcoin. A hedge is a risk management tool that reduces your downside exposure without requiring you to sell your core position. In practical terms, hedging can mean reducing the size of your Bitcoin position at current resistance levels, not selling everything, but trimming to a level where a 30% to 40% further decline would not significantly damage your financial situation or your psychology. Then deploying that capital back into Bitcoin at lower levels if the bear market does continue as the historical pattern suggests. Alternatively, for those with access to derivatives markets, hedging can mean using options or futures to offset some of the downside risk of your spot position, while keeping the core Bitcoin position intact. Buying put options at current levels, for example, provides insurance against a continued decline without requiring you to sell your Bitcoin. If the bear market continues, your puts increase in value and offset some of the loss on your spot position. If the bull market has actually resumed and price continues higher, you lose the cost of the insurance, a small price to pay for the protection it provided. The third approach is for traders who are actively managing positions rather than holding for the long term. For this group, the current setup presents a specific playbook. The primary trade thesis is a short entry on rejection from the current resistance zone, a continuation of the bear market setup, with a clear invalidation if price reclaims the resistance level on a weekly close. The secondary trade thesis is a long entry if price declines to the next major support zone, the liquidity pocket that has been identified below current price levels, with a stop below that zone and a target back at current resistance. Both of these setups have clearly defined entries, stops, and targets. Both of them respect the uncertainty of the current situation. The fact that either the bear market continues or the bull market resumes are both viable scenarios. The disciplined trader does not need to predict which one happens. They need to be positioned for both, with appropriate risk management on each. The fourth approach, and the one that is least discussed but perhaps most important, is psychological positioning. Regardless of what you decide to do with your capital, The most important thing you can do right now is prepare yourself, psychologically, for either scenario. If Bitcoin declines further, to new lows, to levels that feel catastrophic if you haven't mentally prepared for them, how will you respond? Will you panic and sell, the absolute bottom? Or will you have the discipline to recognize it as a buying opportunity, the accumulation zone before the next bull market? Answering this question honestly now before it happens, and making your decision in advance about what you will do is far more valuable than any technical analysis. The traders and investors who consistently make money through Bitcoin cycles are not the smartest. They are not the ones with the best indicators or the most sophisticated models. They are the ones who have a clear plan for every scenario, the discipline to execute that plan regardless of how they feel in the moment, and the patience to wait for the market to come to them rather than chasing every move. Chapter 9. The Macro Context. Global Liquidity and Bitcoin. I want to step back from the pure price analysis for a moment and talk about the bigger picture, the macro environment that Bitcoin is operating within. Bitcoin does not exist in a vacuum. Its price is influenced by global liquidity, conditions, the total amount of money flowing through financial markets worldwide. When global liquidity is expanding, when central banks are printing money, when credit is flowing freely, when risk appetite is high, Bitcoin tends to perform exceptionally well. When global liquidity is contracting, when central banks are tightening, when credit is expensive, when investors are risk-averse, Bitcoin tends to underperform. This relationship between Bitcoin and global liquidity has been one of the most consistent patterns in its history. And understanding where global liquidity is in its own cycle is critical context for Bitcoin's price outlook. The current macro environment is complex. We are transitioning from a period of aggressive monetary tightening, the rate hiking cycle of 2022 and 2023 that was one of the most aggressive in modern history, toward a period of gradual easing. Central banks have begun cutting rates. The liquidity cycle is turning. Historically, Bitcoin has performed best in the 6 to 18 months after a significant inflection point in the global liquidity cycle, when central banks go from tightening to easing and the tide of new money starts flowing back into financial markets. We appear to be in the early stages of that transition. But, and this is important, the transition from tightening to easing does not happen cleanly or quickly. It happens gradually. And during the early phase of the transition, financial markets often experience continued volatility as the economy adjusts to the new monetary regime. Risk assets, including Bitcoin, often have one more significant drawdown during this early easing phase before the new liquidity cycle is established enough to sustainably lift prices. This pattern is consistent with the bear market timeline we've been discussing. A final low in Bitcoin, potentially in the next 2 to 4 months, coinciding with the early rocky phase of the global monetary easing cycle, followed by the beginning of a new accumulation phase as liquidity conditions stabilize and start improving. And then, in 2026 and beyond, a new expansion phase as the improving liquidity environment provides the macro tailwind for Bitcoin's next bull market. This macro scenario aligns almost perfectly with the on-chain and technical analysis. Multiple independent frameworks are pointing to the same conclusion. There is likely one more significant move to the downside before the bear market concludes, followed by an extended period of accumulation, followed by the next major bull run. The exact timing is uncertain. The exact price levels are uncertain. But the structure of what is most likely to happen over the next 12 to 18 months is relatively clear when you look at all of the evidence together. Chapter 10. On-chain data and what it tells us. Let's talk about on-chain data, the unique advantage that Bitcoin provides over traditional financial assets. Because Bitcoin's blockchain is public and transparent, we can see exactly what is happening with Bitcoin holdings across the entire network in real time. And this data provides insights that are not available in any other asset class. The first on-chain metric I want to talk about is HODL waves, a visualization that shows what percentage of Bitcoin's supply has not moved in various time periods. When the long-term CHODL wave is high, meaning a large percentage of Bitcoin has not moved in 1 year, 2 years, or more. It suggests that experienced long-term holders are not selling. They are holding through the bear market with conviction. This is bullish for the long-term outlook. Currently, the long-term holder HODL wave is at historically elevated levels. i.e., significant percentage of Bitcoin has not moved in over a year. This tells us that the people who have held Bitcoin through the decline believe in the asset strongly, enough not to sell at these prices. They are not capitulating, and historically, low long-term holder capitulation is associated with bear markets that are in their later stages, not their early stages. The second metric is MVRV Z-score, a measure of whether Bitcoin is over or undervalued relative to its realized price. The realized price is the average price at which all existing Bitcoin was last moved, essentially the average cost, basis of all Bitcoin holders. When price is significantly above realized price, MVRV is high, suggesting overvaluation and increased probability of a correction. When price is near or below realized price, MVRV is low, suggesting undervaluation and increased probability of a bottom. Currently, MVRV is in a range that historically has appeared during the middle to late stages of bear markets, not at the extreme lows that have marked final capitulation bottoms in previous cycles, but declining toward those levels. This is consistent with the thesis that we are not at the final bottom yet, but we are getting closer. The third metric is exchange flows, how much Bitcoin is moving into and out of exchanges. When large amounts of Bitcoin are flowing into exchanges, it suggests that holders are preparing to sell. They are moving their Bitcoin to exchanges to be liquidated. When Bitcoin is flowing out of exchanges into cold storage and private wallets, it suggests that long-term holders are accumulating. They are removing Bitcoin from the liquid supply for long-term storage. Recent exchange flow data shows a mixed picture. There has been some net outflow, a positive sign suggesting accumulation. But the magnitude of the outflow is not yet at the levels seen during previous final capitulation bottoms when massive amounts of Bitcoin moved out of exchanges as long-term investors aggressively accumulated. The accumulation is happening, but it does not yet look like the aggressive, large-scale accumulation that has historically marked bear market bottoms. The fourth metric is the percentage of Bitcoin supply in profit versus in loss. When the bear market is at its worst, when maximum fear and capitulation occur, the percentage of supply in loss is at its highest. When this metric reaches the extreme levels seen at previous bear market bottoms, it has historically been one of the strongest signals that the bottom is near. Currently, a significant percentage of Bitcoin is still in profit, meaning the current price is above the price at which those coins were last moved. This is because Bitcoin went so high in the previous bull market. Even after a 40% to 50% decline, many long-term holders are still at break-even or in profit. For this metric to reach the extreme levels associated with bear market bottoms, price would need to decline further to levels where the majority of recent buyers are significantly underwater and the temptation to capitulate becomes overwhelming. Taken together, the on-chain data tells a consistent story. The bear market is maturing. Long-term holders are showing conviction. Some accumulation is occurring. But the extreme signals that have historically preceded final bottoms and the beginning of new accumulation phases are not yet present. We are closer to the bottom than we are to the top, but we are not necessarily at the bottom yet. Chapter 11, Sentiment Analysis. Where the market's head is right now. Let's talk about sentiment, because in financial markets, how people feel about an asset is often just as important as the fundamentals of that asset. Not because sentiment determines reality, it doesn't, but because sentiment drives capital flows, and capital flows move prices. There is a famous quote in markets: price is what you pay, value is what you get. The gap between price and value is almost entirely explained by sentiment. When sentiment is extremely positive, price exceeds fundamental value by enormous margins. When sentiment is extremely negative, price falls well below fundamental value. And the journey from one extreme to the other is what creates the cycle. The Fear and Greed Index is the most commonly cited sentiment indicator for crypto markets. It measures a range of factors: price momentum, volatility, social media, activity, market dominance, surveys, and compresses them into a single number. Between 0, extreme fear, and 100, extreme greed. Extreme fear historically correlates with buying opportunities. Extreme greed historically correlates with selling opportunities. During the height of the previous bull market, the Fear and Greed Index was consistently above 80, deep in extreme greed territory. At the worst moments of the bear market, it reached levels below 10. Currently, following the recent relief rally, it has recovered from the extreme fear levels but remains below 50, in the fear zone rather than the greed zone. This is actually a concerning signal from a contrarian perspective. Not concerning because fear itself is bad. Fear is where buying opportunities come from. Concerning because the index has recovered somewhat despite price still being significantly below its all-time high. This suggests that the recent rally has already improved sentiment meaningfully, which means there is less contrarian opportunity at current levels than there was at the lows. For the most powerful buying opportunities in Bitcoin's history, extreme fear, index levels below 20, has been a prerequisite. Those extreme fear levels correlate with capitulation events, moments when the last of the weak hands throw in the towel, when headlines scream that Bitcoin is dead, when everyone who was going to sell has already sold. That is the environment where the most asymmetric buying opportunities exist. We have not seen that level of extreme prolonged fear in this bear market cycle. The sentiment at the recent lows was fearful, but not at the extreme, sustained levels that have historically accompanied final bear market bottoms. Social media sentiment tells a similar story. At genuine bear market bottoms, Bitcoin discussion on social media essentially disappears. The people who were talking about Bitcoin during the bull market go quiet. The noise drops to near zero. Nobody wants to talk about an asset that has been declining for a year and looks like it will never recover. We are not at that point. Bitcoin is still being discussed extensively. The relief rally has generated significant engagement and excitement. People are still paying attention, and historically, that level of attention, that continued engagement, suggests that the final capitulation, the final flush of interest and hope that precedes the real bottom has not yet occurred. All of this points to the same conclusion as the technical analysis, the on-chain data, and the macro context. The bear market is real. The relief rally is real, but likely temporary. The final bottom is probably ahead of us, not behind us. And the patience to wait for that final low, rather than chasing the current bounce, is the most valuable tool you have right now. Chapter 12, the game plan, scenarios and responses. Let me now lay out a clear, specific game plan for the various scenarios that could play out from here. This is the most actionable part of the video, so I want to be as concrete as possible. Scenario 1. Rejection from current resistance and continuation lower. This is the primary scenario based on everything we've discussed. Price fails to sustain above the current resistance zone. It rolls over, sells off. The question then becomes, where does it find the next significant support? The first major level to watch is the previous local low, the level where price found temporary support before the recent bounce. If the bear market continues, this level will likely be tested first. A reaction here, a bounce from this level, would be expected. The key question is whether that bounce creates a higher low relative to the previous bottom, or whether it fails and continues to new lows. If price breaks below the previous local low, the next target is the major liquidity zone below, the area where significant stop losses are clustered and where the most probable final accumulation zone exists. This is the level where, based on historical cycle analysis and on-chain data, the most powerful buying opportunity of this cycle is likely to emerge. For traders, the plan in this scenario is to wait for price to reach the major support zone, watch for capitulation signals, extreme fear, high volume, strong rejection candles, and scale into a long position with a wide stop loss and a target back at the current resistance zone and beyond. For long-term holders, The plan in this scenario is to continue holding the core, position and add to it aggressively when price reaches the major support zone. This is the zone where you want to be buying, not selling. Scenario 2, range consolidation at current levels. In this scenario, Bitcoin neither breaks down significantly nor breaks out to new highs. It consolidates in the current range, between the resistance zone above and the support zone below, for an extended period. 2 months, 3 months, potentially longer. This scenario is consistent with the accumulation thesis, large players finishing. The process of building their positions before the next directional move. It would look boring, frustrating, and directionless. Price chops sideways. No clear trend. Small rallies, small declines, constant range trading. For traders, in this scenario, the range itself becomes the playbook. Buy the lows of the range. Sell the highs. Rinse and repeat. With appropriate stop losses. Outside of the range to protect against a false breakout or breakdown. For long-term holders, this scenario requires the most patience. Nothing appears to be happening, but underneath the surface, the accumulation is occurring. The foundation for the next move is being built. The correct approach is to hold, maintain your position, and potentially add at the lower end of the range. Scenario 3, breakout to the upside. This is the scenario where the bulls are right. Price reclaims the current resistance zone with a strong weekly close. The bearish retest fails. The structure flips from bearish to bullish, and the next bull market begins earlier than the historical average suggests. This scenario would require specific evidence to be credible, not just a spike above resistance. Those happen during stop hunts and are not evidence of a genuine breakout. A genuine breakout requires a weekly candle that opens and closes above the resistance zone with expanding volume and is followed by a successful retest of the broken resistance zone as support. If this evidence appears, if the weekly chart shows this kind of confirmed structural change, then the game plan changes completely. The bear market thesis is invalidated. The accumulation phase is either extremely short or has already occurred at a higher level than typical, and the focus shifts to identifying the best opportunities for the expansion phase. For traders, in this scenario, the confirmed breakout is the entry signal for a long position with a stop below the reclaimed resistance zone and a target at the next major structural level above. For long-term holders, this scenario requires no action. You are already positioned correctly. The work you did holding through the bear market is now being rewarded. The key in all 3 scenarios is having a clear plan before the scenario plays out, not reacting in real time to each price movement without a framework. Decide. Now, what evidence would confirm each scenario for you? Decide what you would do in response to each scenario. Write it down, and then execute the plan, not the emotion. Teachibor. Chapter 13, Lessons from People Who Have Done This Before. Teachibor. I want to end with something a little different. The human element of bear markets. Because the data and analysis are important, but they only matter if you can apply them while experiencing the full emotional weight of a declining market, with real money on the line. Let me tell you about the patterns of behavior that separate the people who come out of bear markets significantly wealthier from the people who come out worse off than when they went in. The first pattern. The people who do well in bear markets are almost always the people who went into the bear market with a clear long-term thesis, a genuine belief in Bitcoin's value proposition that goes deeper than price appreciation. They understand why Bitcoin is scarce. They understand why decentralized, permissionless money has value. They understand the macro thesis for Bitcoin as a hedge against monetary inflation. And that understanding gives them the conviction to hold and even add through periods of significant price decline. The people who do poorly in bear markets are often the ones who bought Bitcoin, primarily because it was going up. They don't have a thesis. They have momentum. And when the momentum reverses, they have nothing to anchor their conviction to. Nothing to point to and say, even though the price has declined, the fundamental reason I hold this asset has not changed. So they sell, usually at the worst time. If you have been holding Bitcoin through this bear market without a clear articulation of why you believe in it beyond price appreciation, now is the time to do that work. Not because it will make the bear market end sooner, but because the clarity of your thesis is what will allow you to make rational decisions when the emotional pressure to sell is at its highest. The second pattern, the people who do well in bear markets plan for further downside in advance. Before prices drop to the levels that would cause maximum emotional distress, they decide, if Bitcoin goes to X, I will buy more, not sell. They define their levels. They allocate capital in tranches, 25% deployed now, 25% at the next support level, 25% at the support level below that, and 25% held in reserve for the absolute worst-case scenario. This approach does two things. It ensures that you actually have capital to deploy at the lowest prices, rather than having deployed everything early and having nothing left when the real opportunity emerges. And it psychologically prepares you for further decline, so that when prices go lower, your reaction is structured buying rather than panicked selling. The people who do poorly in bear markets are the ones who deploy all their capital at the first sign of what looks like a bottom, who buy aggressively at the 30%, decline, run out of capital by the 50% decline, and then watch helplessly as price reaches the 60% or 70% decline levels where the real buying opportunity exists. The third pattern. The people who do well in bear markets separate their investment position from their trading position. They have a core long-term Bitcoin holding that they never touch, never sell, never hedge, never stress about on a daily basis. And separately, they have a smaller trading allocation that they actively manage, taking advantage of the bear market volatility, executing the range trades, managing the short-term setups. This separation prevents the most common bear market mistake, letting short-term trading logic contaminate long-term investment decisions. If you are looking at your entire Bitcoin stack through a trading lens, every bounce and every dip feels like a signal to act. The noise becomes unbearable, and eventually exhaustion leads to a decision to just sell and stop the stress, usually right before the recovery begins. The fourth and final pattern. The people who do well in bear markets treat the experience as education rather than punishment. They study what is happening. They understand why the market moves the way it does. They read about previous bear markets. They analyze the patterns. They develop frameworks and models that will make them better, more confident investors and traders in the next cycle. The people who do poorly treat the bear market as something being done to them, an unfair external force that is stealing their money. They spend their energy on frustration and blame rather than learning, and they arrive at the next bull market with the same underdeveloped framework that caused them to buy at the top and sell at the bottom in the previous cycle. Every bear market is expensive school. The question is whether you graduate with knowledge that changes how you operate, or whether you pay the tuition and learn nothing. Teachibor. Chapter 14. The Long Game. Why none of this changes the ultimate thesis. Teachibor. I want to close with the big picture, because after everything we've discussed, the bear market duration, the relief rally trap, the historical patterns, the on-chain signals, the sentiment analysis, it would be easy to come away from this video feeling bearish, feeling like Bitcoin is in trouble, feeling like the long-term thesis is somehow threatened by what is happening right now. It isn't, not remotely. Bitcoin has been declared dead over 400 times. Mainstream media has called it a bubble, a fraud, a criminal network, a failed experiment, a Ponzi scheme, a passing fad, repeatedly, in every cycle, with great confidence. And every time, it has recovered from each bear market and gone on to reach new all-time highs that made the previous all-time highs look small. The 2018 bear market took Bitcoin from 20,000 to 3,100. Devastating. And then it went to 69,000. The 2022 bear market took Bitcoin from 69,000 to 15,500. Brutal. And then it went to 126,000. Whatever happens in this bear market, whether the decline continues to new lows or the bottom is already in, the long-term trajectory of Bitcoin remains one of the most compelling investment cases in modern financial history. It is the only asset in existence with a mathematically fixed supply, 21 million coins, forever. It is the only asset that operates completely outside of the control of any government, central bank, or corporation. It is increasingly being held by the world's most sophisticated investors and institutions, and it is being adopted as a store of value, a hedge against inflation, and a global settlement network at an accelerating pace. These fundamental attributes don't change with the price. The value proposition of Bitcoin is not destroyed when the price falls 40%. The scarcity doesn't change. The decentralization doesn't change. The adoption trajectory doesn't change. Only the price changes. And price, in the short to medium term, is driven by sentiment, liquidity, and market cycles, all of which are temporary. So here is the full picture, put simply. In the short to medium term, over the next 6 to 12 months, the evidence suggests that we are in a bear market that is more than halfway done in terms of price damage, but likely less than halfway done in terms of time. There may be one more significant leg down before the final. Accumulation phase begins, and the next bull market cycle gets underway. In the medium to long term, over the next 2 to 5 years, the evidence points to the next major Bitcoin bull market being larger, more institutionally driven, and more globally significant than anything we have seen before. The infrastructure is in place. The regulatory framework is developing. The adoption curve is moving. Position yourself for the short-term reality without losing sight of the long-term opportunity. Hedge appropriately. Manage risk carefully. Be patient, and do not let the noise of the bear market cause you to make decisions you will regret when the bull market arrives. The thesis is intact. The opportunity is real. The bear market is temporary. And the game is long. Disclaimer. This video is strictly educational and does not constitute financial advice. Please consult a licensed professional before making any investment decisions.